Having cash available if you're projecting a recession may come on within the next 1 to 3 months, for instance, could be a strong strategy to help you buy these stocks at discounts. It's absolutely possible to beat the market with just a handful of stocks. And if you do the research properly and do your due diligence, you absolutely can have less risk than most imagine. Welcome to episode 28 of the Visionary Investor Podcast. Today I'm going to break down a sample portfolio a little further for you. So in this portfolio I have in front of me, we have a total of 7 different stocks in 5 different sectors. There's Apple, Microsoft, Costco, Deere, Arthur J. Gallagher, S&P Global, and United Health. For illustrative purposes, these are the weights that I gave in this portfolio. Apple 15%, Microsoft 15%, Costco 15%, Deere 20%, Gallagher 10%, S&P Global 10%, and United Health Group 15%. As a result, as you can see from this chart here, information technology is 30% of the portfolio, industrials is 20%, financials are 20%, healthcare is 15%, and consumer staples are 15%. No one sector is controlling more than 30% of this portfolio. Based on looking at returns over the past 10 years, what we see here is given this portfolio construction, the annualized return would have been 20.4%. The risk based on downside standard deviation would have been 6.5%, and the risk-adjusted return using the Sortino ratio was 2.33. If we compare this over the 10-year time period to the S&P 500, we'll see the annualized return was only 9.7%, the risk being 10.6%, and the risk-adjusted return 0.42. As I've shared in other episodes, while historically over the longer term the S&P 500 does return around 8 to 10%, there are many companies inside of the S&P 500 that are not strong companies, especially from a risk-adjusted return standpoint, and are dragging down the index. That being said as well, since the larger companies make up a greater percentage of the portfolio, if there is an issue with these larger companies and they're having trouble, that will also pull down the S&P 500. When we look at the correlations of these 7 stocks, we notice some interesting patterns. The average correlation is 0.162 based on correlation of negative returns. So that means overall there's a low correlation between these stocks, which is definitely something we want to see because we don't want to see these companies all falling a lot together. We want to see a mix so that our portfolio is more balanced. Now, of course, this is based on 10 years of historical monthly data, but you can use this information to predict for the future where you think your stock portfolio is going to go. Will it have similar patterns or not? Looking at the top 5 lowest correlations, we see Costco and Deere negative 0.2, S&P and United Health negative 0.12, Deere and S&P negative 0.08, Deere and United Health negative 0.02, and just slightly negative Costco and United Health. Based on this correlation matrix, there was a total of 21 different pairings. 14 of the 21 had less than 0.2 correlation. So that means they either had a low correlation with one another or a negative correlation over the past 10 years. As a result, the percentage of low or negative correlation was about 67%, which is a pretty strong number when we're looking at the correlations of the stocks in a portfolio. It's also important to look at the return distributions to get a better understanding of what the risk has looked like. How volatile have the returns been, especially on the downside? I'm not going to go too much into that in this specific episode, but I've talked about it in past episodes. You can definitely check them out to understand the monthly return distribution, kurtosis, skewness, etc. of the actual chart to see, is it following a normal bell curve standard deviation, 3 above the mean, 3 below the mean, or are we seeing wider flat tails, or are we seeing narrow and skinny tails, which is dependent on the company and their returns and how far they have deviated or not from the mean. Keep in mind, this is for educational purposes only, but I'm sharing this to show you that it's absolutely possible to beat the market, and this sample portfolio over the past 10 years would have made you over 20% return. Now, when you look at the downside risk, a key factor to understand here is whether the company is down for 1 month, 2 months, or whether your portfolio is down for a month, a year, 2 years. When you have a longer term horizon, you want to understand and see and project where you think that portfolio is going to be 2 years, 5 years, and 10 years from now. So sometimes there are periods of time, especially during economic downturns like a recession, that a portfolio may be down. The S&P 500 may be down as well. But if you understand the patterns and you're invested into strong quality stocks, then you can do your research again. And if those companies are still trading below what you think the projected long-term price is, that could indicate it's a time for you to add more capital into those stocks. This is significantly easier to do when you have a smaller concentrated portfolio because you don't have to go and research 100 different companies. You just have a handful of companies to look at and see if fundamentals are still strong. More often than not, with a macroeconomic event like a recession, what's happening is the microeconomics or the actual fundamentals behind that individual stock haven't truly changed much. It's just being impacted by a shorter term macroeconomic event. What I'm saying here is, in the long run, if you've done an analysis and you think over the next 5 or 10 years, Apple, which is trading just over $195 at the date of this recording, is projected to go to $300 based on your analysis. And Apple falls to $125 per share. You've done your analysis, you check it over, you redo an analysis to determine if it's a buy point. If you still feel strongly fundamentals haven't changed, in fact, you still believe and you still are projecting Apple's stock price going to $300, well, now you're buying pennies on the dollar. You're able to purchase a stock at an even lower price. The fundamentals haven't really changed, but the stock is falling most likely because of the recession. While I'm not a financial advisor, this is one of the reasons why I recommend understanding and learning more about recessions, because the more you understand, you learn about recessions, the better plan you can make to protect your wealth. Having cash available if you're projecting a recession may come on within the next 1 to 3 months, for instance, could be a strong strategy to help you buy these stocks at discounts. If you're interested in learning more about this, you can apply for our one-on-one program called Protect Your Wealth, where we walk you through the fundamentals, micro and macroeconomics, our recession warning indicator model, and much more to help you learn about the stock market and key patterns that have happened in the past to make strong assumptions and predictions about individual stocks, which you can then take to invest on your own or talk to your advisor further about to see if it fits with your current portfolio. As of November of 2023, Apple stock made up 50% of Berkshire Hathaway's portfolio. What's very interesting is that the top 10 companies account for 88% of Berkshire Hathaway. We hear so much about not having a concentrated portfolio. However, there are investors who have successfully done it, and it's because they've found strong companies, done their research, and stuck with them long term. If they can do it, we all can do it. Is it easy? No, of course it's not easy. But when you have the right knowledge and you understand the markets really well, and you understand how to do a proper fundamental analysis, create a strong valuation, and can make good predictions, you can do it too. When you're looking to protect your wealth, investing in just the S&P 500 or mutual funds can be part of your strategy, but you also can create a strong stock portfolio with just 3 to 7 strong large cap individual stocks by doing your research. This includes fundamental analysis, both qualitative and quantitative analysis, looking at correlations, looking at monthly return distributions, making sure you have stocks in different sectors and that they're balancing each other well. It's absolutely possible to beat the market with just a handful of stocks. And if you do the research properly and do your due diligence, you absolutely can have less risk than most imagine. This is investing reimagined. There are few managers who talk about this strategy, And that's okay. It's not necessarily for everyone, but I want to help educate you on a different way of investing, because perhaps you may want to add in some individual stocks to your current portfolio. You may want to create your own portfolio. Let's work together so you can learn more about the fundamentals of investing, whether that's to continue investing in an S&P 500 index fund or mutual fund, or to shift your focus towards individual stocks. Regardless, that's always your decision. I'm just here to show you the behind the scenes so you can understand really strongly what's going on with your own portfolio and have better and stronger conversations with your advisor. Thank you so much for listening. Please make sure to like, rate, and subscribe to the podcast, and continue listening and watching everywhere you get your podcasts. Have a great day. Disclaimer: this recording and the information contained within is for educational purposes only. The Visionary Investor does not offer any personal financial advice or advocate the purchase or sale of any securities or investments for any specific individual. We are not financial professionals and make no claims to be. Everything shared by us here, on social media, or elsewhere, including all videos, materials, documents, and any other information, are for educational purposes only. Investing of any kind involves risk. It's imperative that you conduct your own research before making any investments. We will not assume liability of any kind for any losses that may be sustained as a result of applying any methods taught by the Visionary Investor. Please click on the link in the description to read our full disclaimer on our website.